earlier on in the week on Monday, we took a look at Aston Martin. That was mainly off the back of the fact that people were writing in and requesting for me to look at that particular company. PZ Cussons, I'm not sure how you say it. They have been requested several times by viewers of the show, and so once again, in the spirit of hitting some of these requests, we're going to take a look at them today. Hey there guys, welcome to episode number 30 of the FTSE Show with me, Chris Chillingworth. So, kind of a landmark show in a way, 30 episodes, pretty awesome. Never really kind of thought ahead. I mean, it makes sense that we'd hit 30 episodes eventually. Makes sense that we'll hit 50 and 100 in the future. But when I first started this up, I really didn't think that far ahead. And so it's kind of cool that we've got this many companies up on this board, and that not even that. What's cool is that we've hit episode number 30 and views are going up. Likes are going up, comments are going up, and if you look at the charts on the graphs and stuff on my analytics, everything's going up, which is awesome. And it means that more and more people are finding the show, more and more people are finding this information useful, entertaining maybe, and yeah, it's awesome and I love it. So every Monday I come in here in my cabin and I record a new episode and we get it out there, and I love doing it. It's awesome, and I love sharing what I do. I've got a massive intrinsic love for stocks and shares, particularly in the UK, because that's where I'm from, and there doesn't seem to be a huge amount of focus on UK shares around, and so I kind of just created something that I wanted to see myself, and it just so happens that other people are interested, which is awesome. So I love that. So we're going to look at PZ Cussons today, or Cousins, not sure, but this is a company brand that's been around for a long time. I know them as manufacturers and producers of bathroom products, but they do a ton of other stuff as well. Commonly requested for, more requested recently because of the whole the virus, and people being very interested in companies that are producing cleaning products and hygiene products, which is something that Cussons do, and so very interesting to look at their numbers. Obviously, we don't have their numbers of 2020 so far. We're only looking at annual reports, so we're only going up to 2019 prior to the virus outbreak here in the UK. And so we can only look at how this company have been performing historically prior to that. But it gives you a very good insight into what's been going on here at this company, and gives you a really good insight into whether or not they're a good long-term investment, which is essentially what I look for. I look for companies, and the companies that are scoring well here are typically companies that I expect to do well over the next 5, 10, maybe even 20 years. We're talking long-term holds here. That's what this show is all about. So let's not delay any further, and let's dive into those numbers. Okay, let's take a look at Cussons PLC, or PZ Cussons. EBIT code is PZC, index the FTSE 250, and these guys are in the personal goods sector. So another really popular company that loads of people watching this show have asked me to cover. So let's go through it. Well, last 4 years, they don't look so good. We're looking at, we could probably include all the way from 2013 down to 2019. Just look at the revenue to start with. So 883 million down to 861, down to 819, up slightly by 3 million to 821. Carries on its descent into 2017 at 809, then down to 739, so quite a drop there, and now down to 689. So year on year since 2013, apart from that 2016 where it went up 3 mil, we have had consistent revenue drop year after year. That's a major concern for me. That's an issue for me, that this is a company shrinking, not growing, in terms of its ability to get out there and find more revenue, find more money to bring into the business. That's not, let's say, the opposite of what I'm looking for at the very first hurdle. So that doesn't bode particularly well. Gross margin is pretty consistent So year after year, we're sitting at anything between 36 and about 39%. On average, we're looking at 38% over the years. Looking at the kind of more recent trend, we're sitting at 38, 38.5, down to 35, and then back up to 36. So we can say it's around that ballpark of about 37% a year, and it's been relatively consistent. There's no obvious trend there. If anything, it's gone down slightly. The slice of the pie that they're getting has gone down slightly, but it's not a big shift. Expenses they look like they're going up. So in 2011, we're looking at 67%. We did have that spike in 2012, which kind of messes the numbers up a little bit in terms of the trend, but that went up to 84%. Then we kind of went back to normality, 70%, 63%, and then it's those 4 years of 2015 to 2018, we're sitting above 70%, kind of clawing towards 75%, and now in 2019, that's jumped back up to that high of 83.6%. And so when we kind of take the whole thing into account, we've had these 60s in 2011, 2014, but the days of 60-odd% expenses a year seem to be far left behind now, and we look like a company that's probably spending a lot more than that now, year after year, and this may be a thing of the future, this 80%, which is a bit too high for me. And again, we've got another trend here going in the wrong direction. We've got expenses going up. Now, expenses will naturally go up as revenue would normally go up, but because revenue's coming down and gross profit's going down and expenses are going up, or at least staying level, the percentage is therefore going up in relation. And so essentially what we're dealing with here is dropping in a fall in revenue. We're looking at a fall in the cost of sales, but to a lesser degree. Therefore, a fall in the gross profit, and expenses sticking around the same level. So profits are coming down, expenses are staying the same. As a result of that, the expenses are taking up a larger percentage of those profits. Looking at interest on debt, historically, not a problem really. About 1 million a year, 1.4. Then it jumped up to 6% of the operating profit. So it went up to 5.6 million. Okay, it's a bit of a jump, but again, still not a major issue here. And now we've seen in the last year up to 6.7 million. And that actually is 16.2% of the operating profit. So we're starting to look at this being too high now as well. And then we come down to the net earnings, and whilst we haven't had any losing years since 2011 onwards, the winning years just haven't been strong enough. 2014 looked like a very average year, okay, but other than that, it's not been good. And again, we've got this 4-year trend here where the net earnings have just been dropping. 8.1%, 7.7% net earnings, 5.4%, now down to 3.4%. And when we look at the actual financial figures here, we're looking at 66 million, 62 million, now down to 39.7 million in 2018, 23.5 million profit in 2019. So that's quite a fall. I mean, you could go all the way back to 2014 and say, from the 97 million that they made in 2014 down to 23 million in 6 years later, and that's been a relatively consistent drop there, apart from 2015. Or you could call 2016 the exception there. That has been a steady drop over 6 years, unfortunately, and that's, again, not what we want to be seeing. Coming down into the balance sheet, assets have fallen, and again, we're seeing a bit of a trend here. 1.16 billion, 1.12 billion, down to 1 billion, down to sub 1 billion, 947 million. So the last 4 years, we've seen the value of the assets falling with this company. And historically, debt hasn't been a problem. Not a problem at all. They've been borrowing very small amounts, nothing too big deal. Short-term debts have been relatively high in the past, but they seem to have got those under control. But now we're looking at the long-term debts. So they may have shifted that debt from a short-term to a long-term debt, perhaps. That may be what's happened here. But we're looking at a company that's biting off more than they can chew, in so much that they've got 204 million in debt. and they're making about 23 million profit a year right now, based on current earnings. It's going to take them about 9 years to pay off that debt. For me, that's too long. It suggests that debt level is probably erring on the side of being a bit too big for the size and the earnings power of this business, unfortunately. Equity, the assets minus the liabilities, gives us the equity of the business. We're looking at a steady drop year after year. It's not been a huge drop. I mean, we're looking at 4 million there. We're looking at essentially 12 million between there. So it's hemorrhaging money, if you will, but at a very slow rate. It's a slow death, if you will. And they may turn this around in the future. When I say slow death, I'm kind of condemning them, and I shouldn't really say that because this is a company that could absolutely turn this around. But based on the facts, based on what we're looking at, the numbers that are in front of us coming up to the latest annual report, the last 4 years have definitely seen the equity falling in value from 550 million down to 450 million. So that's a real shame, and that's again something that puts me off. Retained earnings in a pretty decent position though, and we've seen some consistent growth there. I would say the couple of years where it hasn't grown, but on the whole, retained earnings have definitely grown here from 438 million in 2011, now sitting at 543 million in 2019. That's good. That's really nice to see. They've got a big chunk of money that they're sitting on there. That's going to really help them out. This is a company that are spending 200 million a year on expenses. So during 2020, when this is a company that may not be making a huge ton of revenue, and maybe they are, based on personal goods companies have done pretty well during the 2020 crash, and the reasons behind that crash. But if we were to assume that they've made no revenue in 2020 and their expenses sitting at sort of 225 million, and if they're sitting on some cash there, then that's going to help them out a little bit in terms of getting through this crisis. The return that they're making off the equity is very poor, only about 5%. And overall, this is a company, once again, that just do not tick the boxes. They're pointed in the wrong direction. Everything's looking down rather than growth. Everything's looking like it's shrinking rather than growing. And that, for me, is not a wise investment. Let's go and take a look at the chart. So this is an interesting chart because as we saw during those numbers, from about 2015 onwards, maybe 2016 onwards, we've definitely seen a decline in the numbers. We've seen year-on-year decline in many different measurables that we were looking at during those numbers, not to mention the net earnings, the drop in revenue, and all that kind of stuff, the increase in expenses. And this looked pretty poor, and certainly the share price has reflected that, in so much that, as we can see from probably highs in 2013 of £4.40 a share, we've seen it fall up to sort of beginning of 2018 down to about £3.20 a share, now all the way down at £1.80 a share. And you would not be able to argue that this is due to the 2020 crash, because this has been a steady decline for many years now, well prior to that crash happening. And if anything, I mean, they've recovered from that crash almost and are just continuing that downward slide. They're still reverting back to the mean in a way, because you can see here the decline here in March, mid-March with the 2020 crash, and we can see the recovery towards the end of March, and then they just continued the downward trajectory basically across into April. So where many of these stocks, UK stocks, did really well in April, this is a company that didn't do so well in April by the looks of things, and they certainly, it looks like they fell in value over that time perhaps, but and I don't know the exact numbers or the exact percentages of whether they did or didn't fall, but it looks like they did. And this is a company that is clearly in decline, clearly not moving in the right direction. Investors looking at £1.80 a share, maybe licking their lips with this company, but for me, no way. I'm not seeing anything in the numbers that would suggest that they're undervalued. This is a fair share price relative to the performance of this company over the last 4, 5, 6 years, and I like cheap companies that have fantastic financials, and those do exist from time to time. Quite rare, but when you do find them, you can sometimes find these companies that are doing very, very well financially. They're growing, they're doing better than ever, and they've got a cheap share price relative to their intrinsic underlying value. Those are the bargains. Those are the companies I'm really interested in. But when you're looking at a company like this and the financials are all looking poor, they're all pointing in the wrong direction, and they've got a cheap share price, they deserve that cheap share price. And it wouldn't surprise me if this continues to go down and they go below £1 a share based on these financials. So let's go and take a look at how they performed on the leaderboard. Okay, so they didn't look as bad as Aston Martin last week. I'll give them that. Not quite as dire a situation, but still, I mean, too many trends going in the wrong direction. Not a strong company for me. They do have that retained earnings sitting there that's going to protect them a little bit from any difficulties they may come across in 2020. Hard to know whether or not a company like Cussons are going to do well during this period or poorly during this period. Hard to say. But looking at their history over the last 5, 6, 7 years, this is not a company that have been performing in the way that I would want a company to be performing, that I was potentially going to invest into for the long term over the next 10, 20 years. And so when we score these companies, we're scoring against that. We're scoring against all the measurables that I look for that give me indications that these companies are going to be very good companies over the next 10, 20 years. And so if this company are showing downward trends, they're showing shrinkage rather than growth, clearly they're not going to be doing well on this particular process. Short-term opportunities, maybe there are short-term opportunities here. That's not the kind of investor I am. You know, I get people who watch this show and they say, or your video came out on Monday and Thursday the stock rose 3%, so what do you know? Listen, I'm not predicting what's going to happen over the next week. I'm not making really any predictions. I'm just looking at the numbers, and sure, a stock price can go up 3% in a week, but next week it'll be down 3%, so it really doesn't make much difference to me what's happening in the short term. I can't predict the short term, and none of the financials, none of the numbers can tell us what's going to happen in the short term. I honestly 100% believe you cannot predict the stock market in the short term. What you can do, however, is over the long term, put the odds in your favour of success. I.e., you can look at these companies and you can identify trends and patterns and financial strength in certain areas, even in the way the company is doing business, the way the company is reinvesting its profits into the right areas for continued growth, for share price growth in the future, and asset growth and equity growth, and all these different measurables that you can look at to see a company that's growing, that's probably going to be worth far more in 20 years' time than it is today. That I can do. That I can look into these numbers and do and go in with some pretty strong certainty that I'm going to make money out of these particular companies. So sure, you know, there may be some short-term benefits from investing in Cussons over the next month, over the next few weeks. How do I know? There's no way of me knowing that. But long-term, over the next 5, 10, 15, 20 years, I don't see anything in the numbers right now that would suggest that I should be investing in this company for long-term growth. I just don't see it. There's nothing there. So as a result of that, unfortunately, Cussons, or PZ Cussons, they score a rather poor minus 98 points. Let's get them up on the board. Okay, and so this makes them the last company that are filling an empty slot on this board. So from here onwards, in future episodes, if a company manages to score higher than minus 111, I had to check, then they'll go on the board, and the company that are bottom are going to get kicked off. And they said team then. They're going to get kicked off. They're going to get relegated, and we won't see them again. So Dixon's right now are on the verge of being kicked out unless next week's company score worse than 111 or minus 111. Listen, next week I'm going to pick a corker. I'm going to pick a great company. So make sure to tune in next week, because we've been hitting some of these companies that people have been requesting, and they've had dog awful scores. You know, nothing I can do about that. But I did want to hit some of those requests now. Next week we're going to go for a company that I want to pick, a company that you'll be impressed with, a company that's going to score nice and high on this leaderboard. Thank you for watching, guys, and I'll see you next week. Cheers.